Welcome to Financially Speaking, brought to you by Buska Retirement Solutions and its affiliate firms. We offer retirement, tax, and legacy planning from a dedicated family-built team. In today's episode, we'll walk through fixed and fixed-indexed annuities, how they work, and if they belong in your strategy. Later, we'll talk about how you can protect your family from identity theft. And now for our weekly question and answer segment.
Welcome back to Financially Speaking. Today I'm with Zach Kihas and Ryan Connor from Buska Retirement Solutions to walk through fixed and fixed-indexed annuities, how they work, and if they belong in your strategy. Gentlemen, welcome back to the show.
Thank you.
Let's start off with what distinguishes a fixed annuity from a fixed-indexed annuity.
Yeah, so with a fixed annuity, those are relatively straightforward products as far as the return you're going to get. So like it says in the name, your return is going to be fixed based upon an interest rate agreed to you between yourself and the insurance company who issues the product. So you can kind of think of it conceptually like a CD, though it is not FDIC or NCUA insured. You know exactly what your rate of return is going to be for a fixed period of time. So for example, if you have a 5-year fixed annuity that pays out 5%, you are going to get a 5% rate of return for a 5-year period of time. At the end of that 5 years, contract is over, kind of determine what to do with your money at that point in time. Now, with a fixed indexed annuity, the interest it earns is going to be based upon, could be based upon a wide variety of things, but it's going to be based upon a market index or multiple market indices that you choose. Now, you're not going to lose money if those market indices go down. So if let's say you choose the S&P 500, that's a very common one that is built into a lot of indexed annuities. And let's say you have a 2008 type year where the S&P goes down, 40% or better. You're not going to lose money. Now, when it goes up, you are also not going to gain as much as the S&P actually went up.
Fair enough.
Part of the security that the product provides is that your rates of return on average are going to be lower than what the market provides. There are all sorts of ways, and I'm sure we'll dive into them, about kind of how those products are priced, the kind of rates of return expectations you should have as an investor. But fixed is exactly what it sounds like. You're getting a fixed rate of return, whereas indexed are going to be based upon a variety of market indices that you can choose as the investor.
Okay, well, you must have a crystal ball because you kind of got into my next question there. How does something offer you upside growth that's tied to something that can go up, yet a floor of zero with nothing tied to something that can go down? How does that work?
Obviously the insurance carriers have their little formulas, but when they give you the downside protection, in simple terms, they're taking away the top side, the high ups on, what you're going to offer. You're either going to have some sort of participation rate in the index or a cap.
Okay. And so now the annuities, you mentioned the growth engines or how the interest is calculated is different in those two. One's fixed and one is higher or lower, whatever it can be. What commonalities do the annuities share?
Yeah, so for both the fixed and fixed index annuities, we want to talk about how our firm discusses risk. Yeah. We treat both of these products as green money. Now, folks have watched any of our prior shows, they should be familiar with the green money concept being what we call safe investments. So if, just to use a theoretical number, if you were to invest $100,000, at minimum, a year later, assuming you didn't take any withdrawals, the account should be at least $100,000. Whereas with a fixed one, of course, you're going to get some sort of rate of return based on whatever the interest rate is. But on the indexed one, even if the underlying market indices perform very poorly, go down, you're still protected. Part of the contractual agreement between yourself and the insurance company is that when financial markets are not performing well, they still provide you protection from those. They insulate you from that kind of short, medium-term volatility. Now, in exchange, like Zach talked about, you give up higher upside returns. You're not going to, see a situation where, the S&P 500 goes up 30% in a year. On the indexed annuity side, even if you're linked to the S&P, probably not going to get a 30% return.
Sure.
If anyone is trying to pitch it as something where, you can participate in market gains, but you are protected from market losses, that's exactly what it sounds like. Too good to be true.
Right. Okay, and what are the downsides to these things then? Obviously, getting a above average reasonable rate of return is great. Tax deferral is great. Protection from loss is great. What's my trade-off?
Well, your trade-off is you're going to enter, sort of a contract. A lot of them are either 7 or 10 years. So, I mean, for that period of time, you're saying, hey, here's my money, say for 10 years. And then, I mean, a lot of the products after the first year, yes, you can take 10% out without penalties, but you're locking majority of that up for that period of time. And then the other trade-off is kind of what we touched on earlier, is you're capped on how much you're going to make.
Sure.
Either be, you're using a fund that's capped itself, or you have participation rates in the indexes. So with the participation rates, they're really, I should say they're usually not 100%
Sure.
in them.
And do you normally, when you run across retirees, do they want the ability to get a high rate of return, or do they prefer that to not get a low rate of return with a negative sign in front of it?
Yeah, usually they're looking for more security at this point in life. The trade-offs that you are willing to make as a 30-year-old investor are very, very different than as a 60 or 65-year-old investor. And while, sometimes, people think, okay, getting too conservative can be irrational. As you're actually getting into that income phase, that increased level of conservatism in your investments actually makes a lot of rational sense.
Right.
Because you don't want to expose yourself to sequence of returns risk. One of the ways you can help hedge against, having to tap income from investments that are exposed to market losses is to have money in these types of green money vehicles. Doesn't mean they should be the entirety of your portfolio, because of some of the limitations that Zach talked about liquidity, timeline, limitations on growth. You can still get quality growth rates in the products depending on the interest rate environment, but they're not going to be double digits over the course of time with any sort of sustainability. But having a portion of them, depending on your particular situation, can be a nice way to hedge yourself against risk, kind of giving retirees that peace of mind that, hey, when financial markets are having rainy days, my paycheck every month is still going to come from my investment account.
Which is the important part to it all.
Indeed.
So it's not they don't need the high returns. They just need to not take a whooping on the way through.
You're really you're smoothing out the ride.
Financial. I like that, smoothing out the ride. What peace of mind does that give people? Do when the market does, if I do have green money and I've got market money, my income's coming in, like I'm set up pretty good. Like you're saying, I can weather the storm over here. Do people remember that? Or if the market goes down, do we still get some phone calls? And what's it supposed to do?
I mean, it depends on when the last time the client had the review, because I mean,
this is my level of understanding.
So like if somebody was, they haven't had a review in 10 months and the market starts dropping, they're gonna usually get panicked, call in, be like, hey, talk through their situation. You have these investments and
Remind me what I have.
Yep. Or, if it's a newer review and, it's something in the economy brewing, they're probably preparing that, hey, this might happen. And this is why we have your allocation the way you do, or the way we have it, so you can ride out, that storm that could be brewing.
Good. And I know there's a lot of negative things in the press, of annuities. They keep all my money, or whatever, fees are expensive, or whatever it may be. Do a lot of people still have those negative misconceptions when they come in? Or, I mean, the annuity sales have, quadrupled, quintupled in the last 5-10 years. Is that kind of old news, or is that still happening today where people have misconceptions about them?
A lot of the product builds have changed is a really big part of it. You don't have situations where fees on the product are necessarily at the levels that they were 15, 20, 25 years ago. Another thing is folks are also utilizing a lot of different types of annuities rather than just doing straight annuitizations of their annuities. A lot of them are using more accumulation, where you're taking free withdrawals, banking some returns. One advantage sometimes is actually in terms of, Zach talked about, they have these periods where, you're putting your money in there, is it can actually help prevent you from being your own worst enemy.
Sure.
Because rather than going in and perpetually tinkering with your account every time financial markets do something, you're taking a portion of your money and just kind of dedicating it, putting it away, so you can actually avoid becoming your own worst enemy, especially because if you've got that security there, it allows you with kind of, the managed money or the at-risk money to actually be able to weather those storms without, creating at least too much anxiety.
Right, relying over here and you're letting the market money do what it's supposed to do.
Exactly.
Let's get a little deeper into that. We got to take a quick break here. After that short break, we're going to explore crediting methods, liquidity constraints, and ideal planning scenarios with annuities. So don't go away. We'll be right back.
Do you have a plan for how your assets will be handled after you're gone? Without one, the state could end up making life's most important decisions for your family. Through our partnership with the State Guru, we make estate planning process simple and affordable, offering wills, powers of attorney, and revocable trusts. On average, our service costs 70% less than the traditional estate attorney fees, and you may even qualify for free financial and healthcare power of attorneys. Call our office today to get started.
And now back to our weekly question and answer segment.
Before the break, we compared fixed and indexed annuities and the basics of how FIAs credit interest. So let's go a little deeper with that. Back to the annuity subject. You used the word caps, spreads, participation rates, industry jargon. What are they and how do they impact returns?
Caps, kind of think of how the name is itself, a cap. It caps on your upside potential. So
Top of what you can get?
Yep, how much you can make.
Okay.
So, say in simple terms, you have a 10% cap. If the index you're in goes up 6%, well, you're below that cap, so you're going to make 6%. But let's just say that same index goes up 15%, well, you're going to cap out at
the ceiling.
Yep, the 10%.
Okay.
Where participation rates, you're going to get a percentage of that. So let's just use simple numbers and say 50%. If that index over the year goes up 10%, well, you get 50% of that.
5.
Yep, you're going to make 5.
All right. Easy enough.
Yep.
What about a spread?
Yeah, so a spread is a little bit different. So one thing is the spread is not a fee, but it is a deduction on the amount of interest you get if there is growth.
Okay.
So you can kind of think of it as like an after the fact fee.
Okay.
So if your index doesn't go up at all, you don't pay a fee. A common spread, if there is a spread built into the crediting rate, it's going to be like 1%
Okay.
on a lot of these. So let's say you just have 100% participations, keep the math as simple as possible, and you have a 1% spread. Let's say the index went up 10% for that year, so you've got 10. Then you just subtract 1% off of that, so the interest you earned was 9.
Okay.
Basically, all of these different structures are just different ways that the actuaries at the insurance companies have to build out these products to make sure that the rate of return within them is appropriate for the risk level that the investor is taking on.
And is there one that they hope you don't pick? Is there one way to outsmart them all?
Generally, actuaries are pretty good at math.
Is that what that is?
So the way that I describe it is what we are trying to do when we make recommendations within, because all these different products can offer a wide variety of different options. Some that have caps, some that have participation rates, spreads, and we've been using relatively simple index, options like the S&P 500. There are all sorts of different multi-asset ones that can get much more complicated in terms of their structures. We generally like to lean towards more equities-based ones. They're more transparent, simple, easier to track, and oftentimes more effective over time. And so those are generally the ones that we tend towards, your S&P 500s, your NASDAQs, your Russell 2000s, things like that. But, is there a way to quote unquote outsmart them? I wouldn't say so necessarily.
Because they don't really care which one you pick. They're just options.
Yep, there are options available for you, and they're all designed to, from their perspective, to try and provide a range of returns that is appropriate for the risk level that the client's taking on.
And I suppose if you had a crystal ball, you could pick the right one.
Yeah.
But if you had a crystal ball, we wouldn't be sitting here talking, would we? You talked about lengths of contracts, surrender terms, surrender charges. That you're committing to the insurance company, being able to access some money. Talk about the surrender terms, what's typical, what are my liquidity features, how do I get money when I need it? Give me kind of an overview on that.
Surrender charges, surrender schedules are kind of on a sliding scale. You're giving your money for 10 years, so they don't want you to come in tomorrow and say, hey, give me all my money back. So in year 1, they make the penalty a little bit more steep, and then as you get closer to the end of your contract term, it gets very minimal, just because you're almost there.
Sure, and I suppose you're not. You only have so much in this. You have other money too, so it shouldn't be the only money you need to access. What does liquidity look like when I do need money? Let's say for income. I don't need to buy a boat with it. That's my problem. But if I just want it for income, what kind of things can you do?
Yeah, so a lot of this depends on what type of annuity you're choosing as well. So you may have an annuity that has, whether it's a fixed annuity or an indexed annuity that has an income rider associated with it. In that case, you might just be triggering that income rider to generate lifetime income for yourself. And that'll be determined, depending on how much money you've put in, how old you are, how long you've been in the product. A lot of the, what are called kind of accumulation annuities that are become more and more common now, those are going to have particular percentages either of the initial premium, but more commonly of the account value for that given year. So let's just say, you have an annuity that's worth $200,000 and has a typical 10% free withdrawal allowance. You are able to withdraw 10% of that $200,000 without any sort of surrender charge or penalty.
Got it.
So in a given year, you can withdraw up to $20,000 from that account. Now, if it's pre-tax, of course, you're gonna have to take taxes out of that.
Sure, but you're gonna have to do that anyway.
You're gonna have to do that regardless of what product type it's in.
Right.
And so this can be a really useful place to put money to help supplement income. And so the way, from a planning perspective, we may want to try and do that is going to be to position it to where, we can really load up the income need on something like this during times when financial markets are not behaving necessarily very well. So in a time, whether it is, 2008, kind of the first half of 2020 during COVID, 2022, or even just this past April, those can be really useful times where supplementing your income from those types of assets can be really valuable in saving your portfolio.
And so what is the fixed versus fixed index annuity? Is there like a time frame, or how do I know which is better for me?
One is, it really comes down to the preference on what sort of, risk level you want to take per se, because a fixed annuity is kind of, in a nutshell, like a CD.
Sure.
So you're going to just get your that stated return, but really you can choose say a 3-year or a 10-year one. So the term length isn't really saying, hey, if you have a 10-year timeline, you have to go this route.
Right, okay. So it's just more of a matter of choice.
Yep. And some of it is just going to be return potential because, with a fixed return, what I always say is the benefit is the return. The downside is the return. Because typically on fixed products, because you are taking on less risk as an investor because the return is known, the average rate of return on those products is generally going to be lower.
Okay.
Versus like on an indexed product because you are taking some risk, not downside
and maybe
risk.
a longer time horizon.
Yep. Yeah, most of those products are going to have 7 or 10-year timelines versus where you can get fixed ones, very, very short terms. With an indexed one, there is variability of return. So you're not going to lose money, but your return for 1 year might be 2% and the next year might be 11%.
Sure.
Whereas with a fixed, it might just be 4% every year for that 5-year period or something like that.
So back to smoothing out the ride, which ride do you want to take? And but with the downside being 0, it's also a nice little buffer there.
Right, yeah. Kind of the worst case scenario is not that bad.
Right. How do you compare? We compared fixed to fixed indexed annuities. How do I compare these fixed index annuities to like other safer alternatives like CDs or bonds? Like, what does that comparison look like?
Yeah, so with CDs, the big thing is, especially right now, a lot of the terms on those are very, very short. And so, sure, you can put money into a CD, but you're only really banking your rate for maybe 6 months, 9 months, maybe 2 years right now.
Right.
They're very, very short term. Whereas with a fixed annuity, you might be able to get more term length, and on an index one, you might be able to get significantly more term length.
Got it.
Now, the big comparison here, I think, is really actually bonds, because a lot of investors misunderstand how safe bonds are.
Yeah.
If you're invested in a bond mutual fund, which is how the vast majority of, normal folks are exposed to bonds, those valuations can move. A lot of investors found out for the first time in a long time in 2022 that those investments were subject to loss, whereas something like a fixed annuity or an index annuity would be protected from that market downside.
Good. Well, gentlemen, I appreciate that. I know that annuities are one of the more valuable retirement planning tools, also one of the more misunderstood or, misconceptions going on about them. So I appreciate you guys educating us on how to work. And if any of you guys have been looking at annuities, own annuities, have questions, call these fine gentlemen right here. They'll be happy to help you and get you in the right direction. Thanks for joining us today, fellas.
Of course.
Thanks for tuning in. Thanks for watching.
At Buska, our goal is to streamline the retirement planning process to help you move towards a successful retirement with confidence and ease. Through our 3 companies, we provide a comprehensive approach to planning your future. We work closely with you to create a personalized, comprehensive retirement plan that reflects your unique goals and financial situation. Our team integrates investment management, income planning, tax strategies, estate planning, health insurance, and Medicare planning all under one roof. That means fewer appointments, less stress, and more clarity as you prepare for life's next chapter. Whether you're just starting to think about retirement or looking for a second opinion on your current plan, we're here to help you feel more confident about your financial future. Call us today at 715-355-4445 or visit retirewithbuska.com to schedule your complimentary, no-obligation consultation. Let's make retirement planning easier together.
And now our Financially Speaking weekly desk segment.
Welcome back to Financially Speaking. I'm Sue Buska from Buska Retirement Solutions, and joining me today is Ryan Pekka. Now today we're going to talk about how you can protect your family from identity theft.
This is such a great topic because keeping your data safe really does go beyond protecting your money. I'm excited to dive into this.
Me too. So let's start by talking about what identity theft is. The Department of Justice defines identity theft as all types of crime in which someone wrongfully obtains and uses another person's personal data in some way that involves fraud or deception, typically for economic gain.
Yeah, that's a pretty broad definition, but it makes sense because identity theft can happen in a variety of ways. A criminal can do what's called the shoulder surfing, which includes things like camping out somewhere near you and watching as you punch in a credit card number, or listening when you give your card number over the phone.
Wow, another way criminals can steal your identity is to go through your trash. You know those pre-approved credit cards that come in the mail? If you toss one without shredding it, a thief can take it and try and reactivate the card.
They can also sometimes intercept your mail before you even get it. And your snail mail isn't the only way identity thieves can attack you. Unsolicited emails that offer you something but ask you to input data are almost always scams. That's why banks and other financial institutions are careful to remind us all that they won't call or email us asking for social security numbers or any other personal data.
Then once they get your information, criminals can go on a crime spree. They can fill out fake applications for credit cards or loans. They can make fraudulent withdrawals from bank accounts or get a hold of things they otherwise wouldn't have access to if they use their real names.
Yeah, let's talk about how these crimes can affect our viewers and their families. Experian, the credit reporting agency, published an article titled 6 Surprising Ways Identity Theft Can Hurt You. The first thing the article lists is your credit score.
That's a great point, Ryan. Identity thief could open an account in your name and charge all kinds of things to it and never pay the bill. And that can tank your credit score, which in turn can make it really hard to get a mortgage or a lease.
Yeah, it means you may not be able to move to a better apartment, to buy a new home, which can not only affect you, but also have a big impact on your kids. Imagine not being able to move to a better school district or buy a house to accommodate a growing family, all because of identity theft.
And that's definitely a scenario our viewers want to avoid. And health insurance is another big problem that identity thieves can cause for you and your family. If a criminal gets a hold of your social security number, birth date, and health insurance information, and they can get prescriptions or medical care while posing as you. And then when you need care, your coverage is maxed out and you have to pay out of your pocket.
Right. Imagine not being able to get coverage for your kids' health care because some criminal maxed out your coverage.
Yeah, and that's a terrible thing to think about because one way to protect yourself is to keep an eye on the explanation of benefits that your insurance company sends to you. And if they're telling you that you've reached your benefit limit, then you know that you haven't used your plan that much, or you see services or prescriptions you don't recognize. You need to contact your insurer and let them know that you suspect fraud and that they really need to investigate it.
Identity thieves can also steal your tax refund, which is a big problem if you're expecting a healthy rebate and are planning to put it towards something you need.
And that's a great point, Ryan. Watch out for notices of duplicate returns, confusing bills from the IRS, or letters from the IRS about a suspicious return. And if you suspect fraud, contact the IRS right away.
Another thing that identity thieves can rob you of is job prospects. If you're applying to roles that require you to handle money, a prospective employer may run a credit check. And if identity thieves have damaged your credit, it could cost you that opportunity.
Yeah, and that could have a real impact on your family. I mean, it could mean not being able to get a job that pays more or staying stuck in a job that's overly stressful.
Let's cover one more thing before we sign off. Adults are not the only victims of identity theft. A criminal can steal your child's identity too.
And that's right. And someone can use your child's social security number to get a job. And the income they earn will attach to your child's name. When that happens, it can actually prevent your child from getting the right financial aid for college.
Yeah, there are some steps you can take to prevent child identity theft. You may want to freeze your child's credit reports. If your child is a victim of identity theft and denied financial aid as a result, you can file an appeal with the school's financial aid office.
And that's a great point. And with that, we're out of time. If you have questions about protecting yourself from identity theft, reach out to us at retirewithbuska.com or call 715-355-4445. We'll be right back with more Financially Speaking after this.
If you're 59 and a half or have recently changed jobs, now might be the perfect time to consider a 401k rollover. Rolling over your old 401ks could simplify your finances and give you more control from investment options and costs to how and when you make withdrawals. A rollover could give you the opportunity to partner with a financial services professional and tailor your investments to your specific needs, not the company's group plan. Call our office today to schedule your complimentary consultation and see if a 401k rollover is right for you.
With recent market changes, it's understandable that some people are feeling a little anxious about their financial future. That's why now might be a perfect time to review your financial plan. A financial services professional is trained to help you stay focused on the facts, not emotions, when it comes to your strategy. Getting a second opinion today works to ensure your investments are properly positioned to weather market volatility and that you're not taking on more risk than you realize. Let's work to make sure your plan is ready for whatever comes next. Call us today to schedule a complimentary review with one of our financial professionals.
Thank you for tuning in to this week's edition of Financially Speaking. We're glad you were able to join us today, and we hope you learned some useful retirement tips along the way.
On today's show, we covered a number of important topics, and hopefully we did so in a manner that was easy for you to understand. This is the same way we communicate to our clients when we meet with them in person. Remember, with the help of the right financial services professional, you can create a quality retirement, and our team is here to help with that. Right now may be a great time to get a second opinion on your retirement plan. Call us at 715-355-4445 or go to retirewithbuska.com to continue your retirement education, catch up on previous episodes of our TV and radio show, or schedule your complimentary, no obligation consultation.
If you have any questions or comments about today's show, call us at 715-355-4445 or feel free to send us an email at info@retirewithbuska.com. Join us next week at the same time and the same place for another episode of Financially Speaking.